les éclairer. On va maintenant lancer une keynote qui est un peu particulière. C'est GEANAKOPLOS qui a...
We will now launch a special keynote with GEANAKOPLOS of Yale University. We began a research based on an article he had done in 2004 on the demographic predictability of financial markets and started a discussion with him. He was kind enough to complete his article and to update it, and proposes some thoughts, which answer some of the questions asked by Hiroki Miyamoto and Jean-Pierre at the previous roundtable on an original financing of the expenses of Social Security in the sense of pensions. Thank you.
Okay, well, Barry, it's an honor for me to be here and a pleasure to talk about demography. I feel a little bit like the Monsieur Jourdain, Molière's bourgeois gentilhomme, who says that for more than 40 years I've been speaking prose while knowing nothing of it. I've been working on demography for 40 years and hardly thinking about it, but it turns out a lot of many things that I've done are connected to demography. So I am very glad for this opportunity to be able to speak. So let me share some slides and I'll tell you a little bit about two things that I have. Here we go. They're sharing, I hope, from the beginning. And now how do I minimize this? Okay, so there are two things I want to talk about are equity returns and Social Security reform. And a couple other things I've worked on have to do with housing prices and inequality and who has access to credit, which I realize in retrospect I could think of as about demography, because different people have very different access to credit, and it depends a lot on their characteristics, their age, their race, so on. But for now, I'm just going to talk about equity returns and Social Security reform, two things obviously intimately connected to demography. So the first thing is I want to look again at a paper that I wrote. I published it, I think, in 2004 with Michael McGill and Martine Kanzi, two very close friends of mine, especially Martine, who I have known since we were both very young. And I met Michael through Martine, and we published a paper in 2004, I believe, about demography and the long-run predictability of the stock market. And I've now taken a look at that paper again for the first time. And the question we looked at then was, can you use the predictability of demography to predict the stock market? Now, you'd think the initial reaction people have is that of course not, because stock market returns aren't supposed to be predictable. If you knew the prices were going to rise in the future, they would have already risen. Well, if you look at a model of equilibrium with demographic changes, you see that's not true. That was the point of our paper. In fact, the very predictability of the demography makes the stock returns more predictable. That is to say, if people didn't understand the demography and you looked at the effect, it's even bigger than that because you can predict the demography. So demography can have a big effect on stock returns. And basically, you have to change over time. The economy is growing and so on. So it's not returns, it's PE ratios. So let's see why this might be true. If you look at a long history of log of stock prices, inflation corrected, starting from 1870s till 2005, which is about when the paper was published, you can see this kind of sort of cycle, one cycle here, another up and down here, and another up and down there, sort of 2.5 of them. Well, if you look at births from 1910 to 2000, 2002 or so, you get a cycle, the last half of a cycle, another cycle, and the first part of a third cycle. So you've got 2.5 or 3 cycles in stock prices and 2.5 or 3 cycles in births, and they overlap in exactly the right way. Well, so that's suggestive. It certainly doesn't prove anything, but it's suggestive. And then if you built a model, what you would find, as I said before, that in fact there should be, if people are perfectly rational, a connection where when the middle-aged who want to do the saving, that's when their income is highest. People have the highest income and they want to save for old age, so they're putting their money into assets. That's when asset prices should be highest. And when the old or the young are very numerous, that's when asset prices should be lowest. And so the model predicts that there's a connection between the ratio of the middle-aged to the young, 15-year period of middle-aged to 15-year period young, obvious ages. That ratio should correspond to the PE ratio. And here you see that roughly it does. Not perfectly, obviously. A lot of other things happen in the economy, but roughly it does. And here the paper ended in 2002. Okay, right after the crash in the stock market, the paper ends in 2002. And you see there's a connection. Well, I decided, because of this invitation, which I'm very grateful for, I hadn't looked at it in all these years, I decided to extend the data. So now in the paper, we actually ended with this graph where we say in 2002, you see this is 2002, this is the ratio of middle-aged to young. You can predict the demography. So this we got out of some government projection of future middle-aged to young ratios. And here's the projected demography. And if you believe the paper, the PE ratio should take a drop. Things should have fallen for the next 15 or 20 years. And so now we have an out-of-sample prediction. The numbers we got before, were in sample. You might say I rigged the model to fit the data. I don't think I did, but you could say that. But here's an out-of-sample prediction. It's the prediction made in 2002, and now we can compare the PE ratio. So here's 2002, that same high point. This is exactly the projected demography, and here's what the PE ratios did. They did precipitously turn down. Of course, the 2008 crisis had something to do with that, but they stayed down. So I haven't done 2020 yet. 2020 actually would be, totally screwed up because earnings are so far down. But so I haven't put in 2020. But anyway, from 2002 till today, it seems to have confirmed the pattern. So that's what I wanted to say about demography and the stock market. And the argument, by the way, of why rationality, I don't have time to give it, so I'm going to skip to the next subject, but maybe I'll come back to why is it that being rational makes the demographic effect even bigger? It's because the middle-aged, all right, I will say it, the middle-aged who are the savers, if they anticipate, if there's so many people trying to save when they're middle-aged, the interest rates are going to go down. Okay, so that doesn't require looking forward. But now looking forward, if they know that interest rates are going to go down, if the income effect is very big, the middle-aged who are making all their money then and don't have any income when they're older, the lower interest rate makes their real wealth decline. And if they're rational, they will consume less when middle-aged. In other words, they'll save more. So it makes the prices go even higher because they're rationally looking forward to the future. So you get an even bigger effect through rationality. So that's okay. So that's that. Now, what's my second thing about about demography? I want to talk about Social Security reform. Social Security is facing a gigantic problem. It's going to collapse in America. I mean, there's just not enough money to go around. If the taxes and benefits stay the same, the system will go, the trust fund will run out, and the system will go bust in not too distant future. So why is this problem happening? Well, the first reason is because from 1940 to 1970, when Social Security started in America, we gave away a huge amount of money. Someone who retired in 1940 had never contributed, but they got all their benefits. And in the 50s, they got benefits with hardly any contributions. There was a vast giveaway, and though that debt overhang is holding the system back. But then a second major reason is because of longevity and birth rates declining. The ratio of the young workers to the retired was 9 to 1 in 1940. It's about 3 to 1 now. And it's going to head to 2 to 1. So those two things together make it unsustainable. The pay-as-you-go system is unsustainable in America. So what should we do? How can we balance the system? And by the way, there are many advantages to the current system that should be maintained. It's very popular. But there are also a lot of problems with the current system. So while we're trying to rebalance it, maybe we can fix all these other things. So I'm going to propose a way to do all these things together. Now, what do I mean by advantages and disadvantages? Well, the Democrats in America who tend to love Social Security love it because of what it does. So what's the rule? The rule is you look at your lifetime earnings. You get paid a concave function of your lifetime earnings. So that means the more you make, the less your payment grows by. So the poor get a lot more money in benefits for having contributed something than the rich do on the margin. So it's redistributive. It also indexes what you get paid when you retire to the wage of the young workers who are working then when you retire. And then after you retire, your wage is inflation corrected, your Social Security benefits for the rest of your life. So the Democrats love that there's a redistribution based on lifetime earnings. They love the risk sharing across generations. They love the security. You know, you're insured against long life because no matter how long you live, you get an inflation index life annuity. And they also like it because you don't have a chance to screw around with your retirement and lose all your money with a bad investment. The Republicans complain about it in America because they say you don't have a right to your Social Security. The government can change it whenever you like. It's not your private property. It's also very unclear, even to me, how much Social Security I have a right to. You know, they're not telling me every year exactly what I'm getting. And then there's no market prices to tell me what my retirement benefits are going to be worth, even if I knew sort of the share I'm getting out of the whole population. And then the redistribution we talked about based on lifetime earnings, that's all a mystery. Nobody knows how much money they've given up or gotten because they were poor or rich. And also the Republicans like to earn equity returns, and they maybe like some choice. So how can you satisfy the Republicans, the Democrats, and also balance the system? So I've got a very simple suggestion, maybe a little crazy, but I want to make it. And I did this. I forgot whether I said it. It's written with Steve Zeldis, my longtime co-author and also close friend. So GZ means Zeldis. So we propose two things. One is a legacy tax. This giveaway to people in the 40s, 50s, and 60s, up to the 70s, that giveaway, to workers to old people then shouldn't be borne entirely by workers. I mean, it was a decision the government made to give these people money. Why should just workers pay the debt? So we think that we want a legacy tax that taxes the whole economy, rich people who are property owners, everybody, to make up for this debt. So the debt, the accrued earnings of the current people now living who've accrued Social Security benefits, it's around $17 trillion. The last I calculated, probably a little more now. So that's $17 trillion. We want a tax a perpetual tax of 1 or 2% a year that will have present value of $17 trillion to make up for that. Now, but secondly, the punchline is we want progressive personal accounts. So we want to create these new securities. People are paid in something when they make Social Security contributions. They buy with their contributions a PAW, and I want to explain what PAWs are. So each PAW, it's a personal annuitized average wage security. A PAW pays the economy-wide average wage in the year of your retirement. It's a personal average wage security. So you get the average wage the year you retire, plus inflation corrected the same wage, that same number, every year for the rest of your life. So one PAW gives you the average wage in the economy when you retire, and then every year after that, the same real payment for the rest of your life. So it shares risk across generations because what this thing pays you depends on what the young are earning, and it protects you against long life and inflation. And I would make it so that when you're young and each time you pay your taxes, you would buy PAWs, okay, whose price I'm going to determine in a second. You buy PAWs, but the government would tax or subsidize you depending on how many PAWs you'd already accumulated. So people who are, were rich and getting a lot of PAWs already, they would be taxed and would their purchase of PAWs would be taxed. And the people who were poor hadn't earned very many PAWs so far, they would be subsidized with the taxes on the other people. So it would redistribute wealth just as the old system does. So that's why the Democrats should like this. But the Republicans now should like it because you're actually getting a security that you own, a paw. It's hard to steal from you. It's hard for the government to take it back once it's your security. It's very transparent about what it pays, and it helps you with your planning. And also, it's going to be marketable, so it'll have a value. You'll know the value of your retirement savings. Now, how is it going to be traded? 10% of the paws that people are awarded will go into the market, into pools. So they're personalized, but once they're in the pool, they're all put together. So the investors don't have to know about any individual, how long they're going to live. They just know the composition of the pool, how old the people are in the pool. So the paws will all be traded in the pool. And so they'll be marketed. And these marketable securities will, so I'll force 10% of people to sell the contributors will be forced to keep 90% of the paws in their accounts. 10% they'll be able to sell, and with the 10% they sell, they can invest in any equity or whatever they want. So the Republicans will at least get 10% of the money that can be invested in equities, and the other 90% in the old kind of system. But I must say the paws themselves you could look at a little bit like equity, because when you're very young and have 40 years to retirement and you're contributing and buying paws, those paws are indexed by a wage 40 years in the future. That's correlated with the stock market. Wages in the short run are uncorrelated with the stock market, but 40 years in the future, they're more correlated with the stock market. So you could say a little bit that they're stock-like when you're young, and as you get older and there's less time to retirement, they become just safer and safer investment. Okay, and of course, once these things are traded, there'll be a great boon to private insurance companies trying to price annuities, because if you know the value of the paws, most of the paw is constant payment after you retire. That's like an annuity. So if they're traded in huge volume on the market, we'll have a fair price for annuities and for reverse mortgages. Okay, and they can also be used as collateral. So to end the story, I would say that you have to buy the paws on the way in, either being subsidized or taxed, but you can see how much they're worth. So now the government, so a person who contributes money and buys the paws, they're issued by the government. So the government is on the hook. But since they're such a well-defined security, the government could sell them off, not just the 10% directly sold in private markets. The government could think about selling the other 90% to the private markets and force the private markets to put up enough collateral to pay for the paw. And the paw, it keeps the system balanced, because if people tend to live longer, that's going to make the paws more valuable, which means when you buy your retirement paws with your contributions, you'll be able to buy less of them. So the system automatically corrects. When longevity improves, the system is going to reduce the number of paws people get. So on the way in, the system is always going to be balanced. The contributions equal the present value of the benefits. Now, of course, when time goes on, if people suddenly live longer than they were expected to, it may be hard for the government to make its payments. So that's why it might want to lay off the risk to the private sector and force them to put up the collateral to pay for it. But in any case, it'll send an early warning system to the economy that things are changing and the paws prices are adjusting. So you could, if you wanted to, make it more complicated and index the paws not just to the average wage, but to the total income that the young are earning that they're paying in taxes, Social Security taxes. Then you don't have any problem, any risk problem or any hedging problem. The system's automatically balancing. So you don't index to the wage, you index to the wage revenue, the tax revenue from Social Security. Then you're completely balanced all the way through. So that's my proposal, that Social Security is in dire straits. It needs an adjustment now. It needs a rethinking. It's a balancing things across generations. It's a demographic problem. Let's try and solve it with this new kind of security, which could also help the markets and many other markets like annuities and things function much better too. Okay, those are my two ideas. I hope someone might find them of some use and work on them. But I thank you for listening to me. And as I say again, it's a great pleasure to have been invited to this conference and given a chance to speak.
Bonjour, merci beaucoup, Jean-Pierre.
Thank you very much, GEANAKOPLOS. It was truly an exciting reading, and we will have a lot to debate about it. We asked Jean-Pierre GRIMAUD to react. Jean-Pierre is CEO of the OFI Group, which is an asset management group that works mainly with mutual insurance companies, and we questioned him about financial innovation and the future of social welfare.
Grimaud, vous êtes directeur général du groupe OFI et OFI est un partenaire.
Jean-Pierre GRIMAUD, you are the CEO of the OFI Group. OFI is a loyal and very friendly partner of the TDTE chair and therefore of the EIDLL network. You wanted to comment on this issue of finance and demography, perhaps by questioning the potential creativity of finance to address the problem of the day.
Tout à fait, merci François-Xavier.
Absolutely, thank you, François-Xavier. It is with great pleasure that I intervene, and it is a great honor for me to attend the symposium. I indeed think that what has been said earlier on the relationship between demography and financial markets is exciting. And today, one can question oneself precisely about a problem that is mainly a European problem, especially the euro area, that is the impact of negative interest rates. I think we have to realize that today we have about 70% of the investing universe of bond markets that offers negative returns. That means that when an investor buys a bond, well, in the end, he will receive less than he put in as an investment. This is a quite rather strong paradox, and we must ask ourselves about the issue we have today with the aging of populations. These negative interest rates may finally reflect the fact that there is less confidence in the future than in immediacy, since there is a form of punishment, in quotes, from the holder of this bond.
Ces taux d'intérêt négatifs, finalement, ils peuvent traduire le fait qu'il y a une moindre confiance dans l'avenir que dans l'immédiateté, parce qu'il y a une forme de punition, entre guillemets.
And who are the bondholders? These are mainly institutional pension funds, but also insurance companies, which means that when these organizations buy on the bond market with negative interest rates today, that means that in the end somehow they are depleting what they will be able to give back to their savers or pensioners. We are today in this very peculiar paradox of the evolution of financial markets, where these are not necessarily long-term value creators, but rather long-term value destructors. This is because inflationary factors cannot be generated.
Très particulier de l'évolution des marchés financiers où ils ne sont pas forcément créateurs de valeur sur le long terme, mais plutôt destructeurs de valeur sur le long terme. Et cela parce que on n'arrive pas à...
To create a world of negative, real negative interest rates, the public authorities, since it was a choice assumed by the public authorities, to plunge nominal interest rates into negative territory. And since there is very little overall nominal inflation, that makes real interest rates negative. A negative real interest rate is the impoverishment of the person who is the saver. And the saver is not only the person who saves by his surplus of income that he spends on savings, but also and mainly the people who are retired. And thus, a lesser appreciation of the annuity, of the future annuity, is conveyed. It is therefore a real issue at a time when a very large part of the population, it is linked to the phenomenon of aging populations, is in this retirement status. That means that if on this financial part, the person being retired becoming poorer, society as a whole must find another answer to accompany this spirit of life, which is once again considerably lengthened over the past 30 to 40 years. And all the better yet, since it is something very positive for the well-being, the individual and the collective well-being. But it is important to consider how we can finance today the fact that in projection of the 2050s there will only be 1.3 working people to finance one pensioner. So, how to solve this issue? The answer cannot be only financial. That means that we have to build an environment, rethink a society, and somehow think about this new form of social welfare to be built around people. Because once again, the answer cannot be just financial. So it means rethinking solidarity, intergenerational solidarity, rethinking the relationship to the real estate. There can be solutions around it. Probably rethinking the cities and the layout of the cities and the lives of the senior citizens inside the cities. And perhaps rethink the current design of our retirement home system, which too often, and as especially seen in the recent health crisis, reflects isolation rather than integration of senior citizens into the city. And then the problem of care and support. So, there are many topics to explore, which are not just financial and purely financial. I believe that the work that is now being conducted by the chair is in this sense extremely interesting and bearing solutions. There is no single solution. There will never be a single solution to this. There will be a sum of small solutions that will overlap each other to deal with the issue. And of course, the financial world itself needs to rethink how to deal with it, the way to invest, because once again, this negative nominal interest rate phenomenon upsets, and even more than upsets, the standards of investment, and how investment professionals should look at financial markets and look at so-called real assets, which are ultimately assets that are not on the financial markets. And so we have to address all these issues to tackle the colossal challenges that await us in a future that is much closer than we think.